Is all about production and the costs of production. So remember the law of diminishing marginal utility. The more you consume of a product, the less utility you gain over time. Well, there's also the law of diminishing marginal returns. It's the idea that the more and more workers you have working, the less marginal returns and benefit you will receive. For example, let's say we're working at a taco truck, right? It's a pretty small taco truck. Imagine if you had 10 people. Imagine you had like 3 or 4 people, the optimal amount of people you should have in a taco truck. Then you're working pretty well. You're getting things done. But maybe you want 6 or 7 because you want people handling stuff. Then that could increase your returns, right? You'll make more money. But then imagine you keep increasing the amount of people working at the taco truck. 10 people in the taco truck, 20, 30, 40, even 50 plus. Then you're not really making much returns. Each person, it's too crowded in the taco truck, right? That's the idea of law of diminishing marginal returns. The more and more workers you have, the less marginal returns you'll receive in the long term. Only one person would also be inefficient. So don't get the idea that more workers is bad, right? More workers can be good. You just need an optimal amount of workers. Too many workers and you're inefficient. Too little workers, then you're not utilizing all your opportunity. That's the idea of the production function. Now there's 3 different stages of the production function. Stage 1, Stage 2, and Stage 3. In Stage 1, marginal returns are increasing and it's positive. So you see total product, which total product is just how much you can totally produce, a business can produce. So in Stage 1, we see it increasing, right? In Stage 2, we see it increase. It's positive, but it's increasing at a decreasing rate. In Stage 3, it's actually negative. In Stage 1, marginal returns are increasing. We have 1 to 2 workers, which is pretty good. Then in Stage 2, marginal returns are slowly decreasing, so we're marginally getting worse and worse. But it's still positive, so it's increasing. So Stage 2, it continues to increase, but it's increasing at a decreasing rate. And then Stage 3, it's officially negative, it's decreasing, total product is decreasing, and marginal returns are getting worse and worse. So if you understand calculus, right, on here, Stage 1, it's positive. The derivative at this point would be positive, right? The derivative at this point, it's positive, but it's decreasing. So look at this. And then here, the derivative is negative. So if you understand calculus, that's the easy explanation. But if you don't, it's fine. Just understand Stage 1, marginal returns are increasing. Stage 2, it's increasing at a decreasing rate. And at Stage 3, it's officially negative and decreasing. So here's it on a chart. Here's Stage 1, right? Total product is increasing 10, 25, 45. Marginal product is also increasing 10, 15, 20. But Stage 2 is still increasing 60 to 75. But we look at marginal product, it's decreasing 15, 10, 5, 0. Finally, Stage 3, total product is decreasing and marginal product is negative. So here's the idea. And just for your information, product is just the total amount a company can produce. Total product is the total amount they can produce. Marginal product is the additional amount they can produce per worker. So the marginal product of the 4th worker is 15. They can produce 15 more product. An average product is the total product divided by the amount of workers. So total product divided by workers. So now businesses have to incur costs for production. So now we deal with short-run costs. Fixed resources are resources that have the same cost no matter how much you produce of them. Think, for example, the rent on a factory or retail space. Those are fixed costs that no matter how much you produce, you still have to pay. Variable resources are resources that can vary based on how much you produce or time, like energy. The more you produce, the more energy you consume, so the more you actually have to pay. So variable resources are variable, right? They change based on how much you produce. Fixed resources don't change. In the short run is not a specific amount of time. It's not like 1 year or 2 years or 10 years, but rather just the short term. And the short run is when there's at least one fixed resource. So there's at least one fixed resource companies can use in the short run. And now there's different types of costs that we should probably cover. Fixed costs are costs that don't change, like rent, like we talked about earlier, fixed resources. Variable costs are costs that change over time. And total cost, make sure you remember this, total cost is fixed cost plus variable cost. Now, for total cost, you just add the two up and you should get the total cost. Then we also have average fixed cost, average variable cost, and average total cost. Average fixed cost is just fixed cost divided by quantity. Average variable cost is variable cost divided by quantity. And average total cost is total cost over quantity, or it's average variable cost plus average fixed cost. So either one. Remember, total cost is just fixed cost plus variable cost, and then averages are just that cost divided by quantity. And marginal cost is just the additional cost for every quantity. So if the marginal cost was 10, for example, of producing another unit, that means when you produce that other unit, your costs increase by 10. That's short run costs. And now we have a cost curve, which can be a little confusing, but let me explain. So let's analyze each one of these curves, right? Marginal cost. Marginal cost starts out being positive and pretty high, decreases for a little bit, and then slowly increases over time. This is because of the law of diminishing marginal returns. Remember that? The more you produce, the less returns you get. And the less returns you get, the more costs you incur over time. So that's why you see this small dip and then an increase. At this dip, you have the optimal amount of workers you actually have, and then you slowly increase because of the law of diminishing marginal returns. So just remember, marginal costs is like this, kind of like a Nike swoosh. It starts out high, it decreases, and then it increases in a linear line, kind of like this. So now let's analyze average fixed cost plus average variable cost and average total cost. Fixed costs, remember, are fixed. No matter what happens, no matter how much you produce, it's always the same. So let's say, for example, it was 10. The reason average fixed cost plateaus like this, it starts up high and it slowly decreases over time, is because fixed costs are always fixed, but quantity is increasing. So let's say, for example, here, fixed cost was 10, quantity was 1. Then we would have 10 for the average fixed cost. But then let's say quantity here, where I'm at, is 3. Fixed cost is still 10, but average fixed cost would now be 3.3. Then here, let's say quantity was 10, and fixed cost is already 10, so now we have 1. So it's because fixed cost is always fixed, right? It's not changing, but quantity is increasing, the average fixed cost plateaus. So just remember, average fixed cost starts out high, but then slowly plateaus. Then we have average variable cost, which is kind of like this. It's variable like this, right? It's kind of like a V shape. It starts out high, decreases, and then it increases. This is because of the marginal cost in the law of diminishing marginal returns. Fixed cost does not change, so when marginal cost starts increasing like this, it's increasing the average variable cost. So when it's like this, average variable cost starts increasing. So just remember, average variable cost is like a V, kind of like that. And then average total cost is actually the addition of average fixed cost plus average variable cost. So you see this, average variable cost, average total cost, and how it's kind of just above the average variable cost graph. If you add average fixed cost, you'll get average total cost. So just remember, marginal cost is kind of like a Nike swoosh. Average fixed cost starts out high and plateaus. Average variable cost is a V. And average total cost is also a V, but larger and higher up than the average variable cost. AP question for you. Assume that the fixed cost is $50 based on the cost and output data in the table above. What is the marginal cost when the firm increases its output from 3 to 4 units and the average total cost of producing 4 units? So I'll give you a few seconds. Pause the video. So we assume that the fixed cost is $50, right? Based on now let's look at the actual data above. What is the marginal cost when a firm increases its output from 3 to 4 units and average total cost of producing 4 units? So when we go from 3 units produced to 4 units, total variable cost increases by $35. We know fixed cost does not change, it's always $50, so the marginal cost would be $35. Remember, marginal cost is just the additional cost per unit. So in this situation, it would just be $35. Average total cost is the total cost divided by quantity. So let's actually look at that. At 4, variable cost is $90, fixed cost is $50. So we add the two up to get total cost, right? Total cost is variable cost plus fixed cost. So 90 plus 50, we get 140, and we produce 4 units. To find average total cost, you find total cost divided by the quantity. So it's 140 divided by 4, which gives you your average total cost of $35. So you should have gotten B. So now let's talk about long run costs, because costs actually change from the short run and the long run. In the short run, there was only one fixed cost, but now there's only variable costs. There's no fixed cost since everything in the long term is variable. There's this idea of economies of scale, which is the idea of how much a company returns and how much there's costs based on how much they actually produce. So for economies of scale, that means if something's economies of scale, if it's positive economies of scale, that means their costs are decreasing. For constant returns of scale, that means costs are not changing, and for diseconomies of scale, that means there's an increasing amount of cost. So let me show this in a graph. For economies of scale, the more output you have, the less it costs per unit. For constant returns, there's this small portion of time where you just simply don't change at all, and then diseconomies of scale is when costs start increasing. This is because of the law of diminishing marginal returns, right? The more output you have in the long term, the more it costs. So remember, economies of scale, costs are decreasing. Constant returns to scale, they're constant. Diseconomies, costs are increasing. You want to remember this graph, right? Output, cost per unit, economies of scale, constant returns, diseconomies of scale. So now let's talk about profit. Now we already talked about this in Unit 1, but we can cover it again. For cost-benefit analysis, you need to look at the costs of everything, but you also have to look at different profit. For costs, you have implicit costs, which are the opportunity costs of a decision, and the explicit costs, which are the direct out-of-pocket payments. So you have two different types of profit. And remember, profit is just revenue minus cost of production. Make sure you know that. The two different types of profit are accounting and economic. Accounting profit is just total revenue minus explicit costs, which means it's the total revenue minus the out-of-pocket business expenses. So just remember, accounting profit is just the out-of-pocket business expenses like rent, utilities, energy, things like that. Economic profit is total revenue again, but minus explicit and implicit costs. So it includes the out-of-pocket business expenses, but it also includes the opportunity costs of implicit costs. So remember, accounting profit, you have to consider the out-of-pocket business expenses. Don't consider the opportunity cost. For economic profit, it is opportunity cost and the out-of-pocket expenses. So just make sure you know that. Now, there's actually a way for businesses to maximize profit and a rule you have to follow. In microeconomics, you want to follow marginal revenue equals marginal cost. This is the point where businesses maximize the amount of money they can actually make. Because let's say, for example, marginal revenue was above marginal cost. That means there's actually more money to be made, and there's actually opportunity to be made to make more money. Let's say marginal cost was above marginal revenue. That means the business is losing money, so you want to actually decrease output because you're losing money, right? So the point where businesses actually maximize their profit is always marginal revenue equals marginal cost. So now let's talk about the short run and long run. There's this idea of normal profit. This is basically the break-even profit. It's when businesses make as much as they can spend. So let's say, for example, a business spends $1,000, right? Their expenses are $1,000. For normal profit, that means they would earn $1,000. So that means they're not making any extra money. It's just they're getting enough money to cover expenses. This is the profit that most businesses actually get. Then we also have the barriers to entry. Barriers to entry is just anything that prevents certain businesses to enter a certain market. Think copyright, patents, or just financial constraints. These are things that actually prevent businesses and people from entering a market or industry. So remember, barriers to entry prevent people from actually entering a market. Then we also have the shutdown rule. So there's the profit maximizing, which is marginal revenue equals marginal cost. But there's also a shutdown rule. If a firm ever produces and they have a price above, if they ever have a price below AVC, then they should stop producing and shut down. So in this example, if they have a price ever below $4, they would shut down. You always want price to be above AVC. And just remember, if price is ever below AVC, you shut down immediately. So now we have different types of market structures that businesses operate in. There's 4 different types of market structures: perfect competition, monopolistic competition, oligopoly, and monopoly. For now, we're just going to cover perfect competition. There's certain characteristics to perfect competition. There's low barriers to entry. There's many small firms, thousands, millions of firms. There's identical products. So that means all these firms produce similar, identical products. Firms are price takers, which means firms must charge the market price. So that means firms can't determine their own prices. They have to take the price everyone else sells. If a firm in a perfect competition ever charges a price above the market price, that means their profit would be 0. So they're all price takers. They take the price of the market. And firms have no control over price. Basically, firms have no control over price because there's so many firms that they have to use the market price. Also, make sure you know perfect competition is the most efficient type of market structure. The other market structures that we're going to cover in the next unit, monopolistic competition, oligopoly, monopoly, all create deadweight loss, are all inefficient. They actually lack competition. Perfect competition is the most efficient type of market structure. It's the type of market structure we want in an economy. So make sure you know perfect competition is the ideal market structure, most efficient market structure, and firms make a normal profit in perfect competition. So now there's a certain graph for perfect competition graphs. Now, the market, remember, is just supply and demand, equilibrium, price, quantity on the x-axis, price on the y-axis. For a specific firm in price competition and perfect competition, we have a bit of a different graph. So we still have the ATC, we have the AVC, remember, V, but now we also have the marginal cost, which is kind of like a Nike swoosh. It starts positive, decreases, and then starts increasing like that. But now we have a constant demand curve like this. Price equals demand equals average revenue equals marginal revenue. All you really need to know is demand equals marginal revenue equals price. This is because there's so many firms in perfect competition that demand is constant. If price ever increased for a product, they could simply just move to a different product. It's not a linear demand curve like this. It's rather a constant curve like this. And just to test your knowledge, where is the profit maximizing point? Remember, profit maximizing is just marginal revenue equals marginal cost. So this blue dot would be profit maximizing. This blue dot would be the shutdown point. Remember, shutdown point is when price is below AVC. So if price was ever below this blue dot, we would shut down. So make sure you know profit maximizing, MR equals MC, shutdown point, price is below AVC. And now that's everything for Unit 3. Make sure you know and understand production function and understand the law of diminishing marginal returns, all of this, decreasing at an increasing rate, and then negative. Make sure you understand the 3 stages. Make sure you can identify all 3 stages because there's certain questions where you're going to need to identify all 3. Understand short run costs, all of these, fixed variable cost, how to calculate total cost, the averages, understand marginal cost. Make sure you memorize this cost curve. Now, you should understand them conceptually, right? Marginal cost increases like this due to the law of diminishing marginal returns. But even if you don't understand it conceptually, just make sure you can memorize this and understand it because you're going to have to apply this several times in this class. And now, make sure you can understand long-run costs, the economies of scale, constant returns, diseconomies of scale. Make sure you remember this graph too, just in case you need it. X-axis output, y-axis cost per unit. And then you use economies of scale, constant returns, diseconomies, kind of like a smiley face. And then make sure you understand profit, accounting and economic profit, how to calculate those, profit maximization. Make sure you remember MR always equals MC for profit maximizing. All throughout this class, MR equals MC. Just remember, this is the profit maximizing. And then the shutdown rule, prices below AVC, and then understand the characteristics of a perfect competition. Low barriers to entry, identical products, firms are price takers, which means they have no control over price, and also make sure that you know perfect competition is the most efficient type of market structure. Firms take a normal profit, and it's the ideal type of market structure. And make sure you understand that the graph for a firm in a perfect competition, same cost curves, right? Marginal cost is kind of like a Nike swoosh. Average variable cost and average total cost are V like this. And then demand equals marginal revenue, and it's constant like this. Make sure you remember profit maximizing shutdown point, and that's all you need for this unit. Make sure you do the questions in the description because they can be very helpful in memorizing and actually being able to answer questions like these. Because even if you understand all of this, it's hard to actually answer questions that that ask you to apply this knowledge, right? A lot of questions don't ask you specifically what is economic profit, right? They ask you how to apply your knowledge of economic profit to a question. So it's really useful to actually take those AP questions. So I would really recommend you do those AP questions.